We'll come back to the studios where Ghana's central bank today left its key policy rate unchanged, as you heard earlier, at 29%, stating that the country's inflation risks are still to the upside. The financial regulator also announced a new set of rules of cash reserve ratio for different categories of banks in the West African economy. Let's get excerpts from the Bank of Ghana chief, Addison.
International reserve buffers continued to improve in the first 2 months of 2024. The stock of gross international reserves as at the end of February 2024 increased further to $6.2 billion, enough to cover 2.8 months of imports of goods and services, up from the stock position of $5.9 billion at the end of December. The level of reserves defined to exclude pledged assets and the Ghana Petroleum Funds increased to $4 billion at the end of February 2024 from a stock position of $3.7 billion as at the end of December 2023, driven mainly by the Gold for Reserves program and the IMF second tranche disbursement. The foreign exchange market came under some seasonal pressures in February and March, but the Ghana cedi continues to recover its value. The pressures emanated mainly from the strengthening of the US dollar in international markets and payments made for the energy and corporate sectors. These were compounded by delays and uncertainties associated with the second tranche of the cocoa loan inflow and the World Bank's disbursement of budget support. These pressures have been mitigated somewhat by continued inflows from remittances and mining companies and from the domestic gold purchase program. In the year to 20th March 2024, the Ghana cedi recorded a depreciation of 6.8% against the US dollar. Summary and outlook. The committee noted the stronger global growth outturn than expected, continued decline in global inflation, and the stronger United States dollar. The growth momentum was largely supported by resilience in some major advanced economies and emerging markets, as well as a projected rebound in the euro area. These positive developments are expected to spill over into 2024, with global growth forecast at 3.1%, unchanged from 2023. Global inflation has continued to ease on the back of declining food and energy prices and tight monetary policy. Underlying inflation, however, has remained sticky due to easing but still tight labor markets and the lingering effects of currency depreciation. In the outlook, global inflation is expected to decline further, but increasing geopolitical tensions and potential supply constraints associated with developments in the Red Sea could pose some major risks in the outlook. Global financing conditions have remained tight, despite easing inflation due to near-term risks such as the escalating developments in the Middle East, which may impact energy prices and force central banks to keep rates tighter for longer. In the domestic economy, the growth outturn for 2023 was stronger relative to target. The fourth quarter GDP growth of 3.8% was driven by all three sectors. The updated CIEA also improved further in January following the upturn in December 2023, affirming the rebound in economic activity. This was supported by broad improvements in sentiments amid improvement in PMI, reflecting some uptick in business purchasing activity and new orders. Private sector credit, however, remained sluggish, explained by the risk aversion of banks as asset quality weakened over the period. External sector conditions remain positive, with improving reserve buffers. This notwithstanding, the exchange rate came under strong demand pressures in the first few months of the year. Looking ahead, however, inflows from the World Bank, the tight monetary policy stance, and a weaker US dollar from potential policy rate cuts in the US are expected to support the relative stability of the Ghana cedi. Broadly, the banking sector remains stable despite the elevated credit risks. Banks' liquidity and profitability positions have continued to improve. Out of a total of 23 banks, more than half are fully capitalized and have no need for recapitalization. Most of the outstanding banks have met more than two-thirds of the required capitalization over a 3-year period within 1 year, as at the end of 2023. Fiscal policy implementation so far has been broadly consistent with targets under the IMF ECF-supported program. Although the primary fiscal balance target for 2023 was attained, the fiscal assessment is made on commitment basis. This will require vigilance to ensure that commitment control is effective in 2024. Revenue flows in the first 2 months of the year are lower vis-à-vis targets, and expenditures have been fast-paced, driven largely by clearance of arrears in the energy sector. It is expected that revenue flows will pick up in March as the deadline for filing tax returns in April approaches. After decelerating sharply in 2023, the pace of disinflation has slowed in the first 2 months of the year. Although inflation rose slightly in January 2024 and edged down in February, the latest inflation forecast suggests a slightly elevated profile from the possible upward revision in transport fares, adjustment in utility tariffs, higher ex-pump petroleum prices, and some pass-through of exchange rate depreciation. Overall, risks to inflation are slightly on the upside and will require close monitoring. Given these considerations, the committee decided to maintain the monetary policy rate at 29%. Other policy measures. The committee decided to adjust the cash reserve ratio for banks as follows. Banks with loan-to-deposit ratio above 55% will have to meet a currency cash reserve ratio of 15%. Banks with loan-to-deposit ratios between 40% to 55% will have to meet a cash reserve ratio of 20%. Banks with loan-to-deposit ratios below 40% will be required to hold cash reserve ratios of 25%. These policy measures will be April 2024.